Hello, very good morning to all. I'm Kelvin here again. I hope that you all have a great and restful weekend. Very good morning. Today will be the Monday, a brand new week, 11/11, so 11 November 2024. Welcome to today's daily dose of market insights. So, as usual, before we kickstart, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's have a quick recap what has taken shape yesterday, in terms of on Friday and as well as the weekend, and how does it impact the respective broad-based cross asset classes. Then I will share with you all one longer-term, multi-week, multi-month intermarket dynamics that is playing out in the marketplace right now, more or less pertaining to the upcoming US key administration policy towards the rest of the world, and we also covered the latest key short-term intraday technical outlook on those broad-based cross asset classes and the respective short-term intraday key levels to watch out for. And we will sum up for today as usual. Would there be any key economic data to focus on? So let's start with what has taken shape on last Friday. So last Friday, there's actually a couple of key data and events which I want to highlight for you guys. Is number one will be the more or less of a month plus of highly anticipated China stimulus measures that market participants hoping to hear from the China top policymaker. So on last Friday, they actually revealed this 10 trillion yuan of not really new physical stimulus, but more of a debt swap. All right, well, to actually let me expand my screen now. Okay, so that you guys could see much more clear. All right, so they actually gave this indebted local governments, that means the province government, a kind of a lifeline of a debt swap of 10 trillion yuan. Okay, so that is more or less already been penciled into the market. But what market wanting to hear is that prior to this 10 trillion yen, I mean a week ago, before the US presidential election outcome, there was actually circulating rumors among the we talk about the economists in China, hoping for China top policymaker to actually ignite more fiscal stimulus if Trump were to actually win the White House. Why? Because of this incoming additional 60% tariffs that Trump proposed to hit on China imports to US. So during last Friday press conference, where they, the week-long of standing committee meeting, they just rubber stamped this 10 trillion yen of debt swap, but they stopped short of any additional new stimulus, right, over here. So what they did over here is that they did not announce any measures to directly stimulate domestic demand, and one thing. And as usual, the finance minister promised more forceful fiscal stimulus next year. So signaling border steps that could come after Trump's inauguration in January. So it's more like going back to the same old story of rhetoric again. They were saying that yes, there will be more coming, but I cannot tell you how much. And how much will be specifically allocated to which particular sector of the Chinese economy, I can't tell you that as well. So it seems to us that market participants are getting less patient on this kind of rather vague remarks coming out from the China top policymaker, and that causes the Hang Seng futures market to sell off on last Friday when the European session kickstart, and also causes the oil price to indirectly be impacted by this lack of stimulus as well, where the West Texas crude oil actually fall below that $70.50 per barrel. So later I'll touch more on the short-term intraday technical outlook on oil, and that also causes the Aussie dollar to plummet as well below the lower limit of the neutrality level that we highlighted on last Friday. That means breaking below the lower neutrality range, and it went all the way down to close to the 60 around that 62 it went down towards close to that low of last week prices. All right, so net overall doesn't seem to us that to justify any further potential risk on a scenario for China-based and Hong Kong related stock indices, and as well as for commodities market, especially on base metal like copper, and indirectly also oil as well, also start to see this intraday risk of scenario being impacted on them due to this lack of specific coming out from China top policymaker to counter potential Trump higher tariffs towards China imports that could actually wreak much more negative feedback loop into the Chinese economy next year. All right, so then what we could see over here is that in the US stock market, so in the US stock market was rather also a mixed bag as well. So what we could see over here is that the Nasdaq 100 did manage to actually continue a positive feedback loop exposed US presidential election. So on Friday, it actually closed almost unchanged, 0.07%, whereas the top performer remains at the Dow Jones Industrial Average and the Russell 2000, banking into account of that Trump trade narrative again. All right, so still recall the Trump trade narrative in terms of the US stock market tends to see more further outperformance on the Dow Jones and the Russell 2000. Why? Because of policy that is skewing towards a small cap company, lower corporate tax cut, indirectly with the very we call it me against the rest of the world policy, like enacting trade tariffs not only on China but against other countries as well. That's about 10 to 20%. So that could actually lower down revenue on corporation that is pretty much dependent on the rest of the world, which is part of it is the Nasdaq 100 corporation, whereas corporation that is dependent more on the US economic growth tends to benefit, which is the Russell 2000, which is one of them, and as well as the Dow Jones Industrial Average is actually being dependent on also lesser regulation or deregulation of the financial sector that the Trump administration will tends to be embarking on, which you know that the Dow Jones Industrial Average there's much more heavily weighted towards the banking stocks rather than the big cap technology stocks. All right, so what we could see the heat map over here is that on a daily basis, okay, we start to see the underperformance of the mega cap stocks, exception for Tesla. We know that Tesla, because it's more like Elon fact and very Elon Musk will play a part the next upcoming Trump administration. So that also benefited from his cozy relationship with Trump, right? So the only outlay right now was Tesla that managed to gain 8%, but Tesla is not a much more heavy weightage so far in the Nasdaq 100. But the Nasdaq 100 heavy weightage is still on these three top stocks, the Microsoft, Apple, and Nvidia, which underperformed the general market on last Friday. All right, and also we continue to see dollar strength gaining momentum as well because of these lesser, deeper expected US Federal Reserve Fed cuts that's being priced into 2025. So what you could see over here is that the overall 5-day rolling performance of the dollar against the major currency, where the dollar continues to hold firm, all right, against the major currency like the euro, the Swiss, the CNH as well. CNH will be the Chinese yuan, especially on the lack of fiscal stimulus coming out from the China top policymaker, and followed by the Aussie dollar, the dollar against the Aussie, the Kiwi, the CAD, and the sterling. So all of them we start to see shipping a series of push up after the low that was being made on Friday or Thursday late US session, and on throughout Friday they start to rally as well, and this rally also starts to see a push up by this little green line here. So this green line is in fact the premium, the positive premium of the US 2-year Treasury against the rest of the world. All right, that is also giving an uplift to this ongoing short-term dollar strength momentum that is still pretty much intact in the FX market. All right, so this what has taken shape last Friday. So dollar strength coming into the picture. We start to see weakness in the Hang Seng futures. Then as well as we also see we call it this mixed bag performance on the major US stock indices. Right, and gold, not gold, and oil price remains weak as well on last Friday due to this lack of additional fiscal stimulus to counter potential Trump trade tariffs that the China policymakers choose not to announce at this juncture. Right, so that is last Friday. Key and events and data to look out for. And as well as on Saturday, we do see a release of the China key inflation data, which continues to show persistent deflationary risk in China. And this deflation risk in China at this moment in time cannot be eradicated in the current pace of stimulus measure and monetary policy measure that the top policymaker has enacted so far in the last 2 to 1 month. So I could see the inflation rate for October in China continues to actually disappoint. So market is expecting 0.4% year on year. It came in only 0.3%. And we continue to see a producer price index with quite the cost of goods produced in China also clearly back to a deflationary path, negative 2.9% year on year. Market is expecting an improvement of 2.5%, negative 2.5%, negative 2.5% year on year, pardon me, but it's going to plunge much deeper. So if you look at the trend of the PPI, it's clearly in the shape of deflationary mode. Let it run for a while. Okay, let's look at the 5-year trend. Right, so after trying to recover in this July this year up to negative 8%, but then thereafter it continues to resume its downward trajectory. All right, at negative 2.9% for the month of October. So it seems to us that this last 3 months of push down is indicating that deflationary risk in China is still pretty much intact, right? Despite the ongoing rhetoric that the China policymakers try to actually address, but the actual scenario doesn't seem to improve at this juncture. So that could also start to see that so-called earlier optimism that was actually being seen in the last month of last previous 2 months of August, where the China stock market and the Hong Kong stock indices rallied due to this much more anticipated forceful stimulus that China policymaker may be forced to actually ignite. But this kind of optimism will slowly starts to wind down, especially the China top policymaker refused to give in to what market participants wants to see and hear after last Friday way of tonality, right? That means they go back to the same old measure of telling us that yes, there will be forceful physical stimulus measure, but I'm not going to tell you what is the clear exact amount and how I'm going to allocate it according to this measure to the various sector of the economy. So market participants are losing patience on that, and that could potentially may not gel well for the Hong Kong and the China stock market, at least from a short-term perspective. All right. So this is something that I want to share with you guys, all right, in terms of news flow. Now back to the fundamentals and the intermarket dynamics. So one of the longer term intermarket dynamics is more pertaining to the latest upcoming US potential trade tariffs, because at this juncture, based on Trump victory speech exposed US presidential election, he did mention about when will he ignite his trade tariffs, but he knows that he wants to propose these tariffs. Whether he will ignite it in next year or the year thereafter, we will not know. But let me share with you the inter-market dynamics of it, and how does it impact the various cross-asset classes in the previous trade tariffs that he tries to that he already enacted on previously in January 2018. All right, 2018. So that was around the 2 years after his presidency in 2016. So he ignite this US-China trade war 1.0, where he slapped tariffs across the board on China products heading to US, and and that's happened, the dollar actually rallied pretty much sharply, and that causes the China CNH to decline against the dollar. So the dollar also rallied pretty much strongly against the offshore yuan as well, and that causes the Hang Seng Index to tumble, the VIX to increase the volatility in the US VIX. So that was also a little bit of what I call a medium-term correction that took shape in somewhere around in January 2018 as well. And for sure, the Aussie dollar also tumbled as well. So the Aussie dollar is a very close proxy with the CNH. So that means if the CNH tumbled, the Aussie dollar should tumble as well, because this is the inverse, because this is the dollar. Aussie, $1, one Aussie equals to how many USD? All right. So moving in line with also with the Hang Seng Index. Okay. So what you will see right now is that market participants now is now trying to factor in this potential trade war 2.0 by bidding up the dollar, right, and also bidding up the dollar against the CNH. So these are two key levels I want you all to watch out. It's the 106.65 on the dollar index. So right now the market is trying to build up and trying to hit this level again, to retest this level, despite the fact that the Fed is now engaging in an interest rate cut cycle, but this interest rate cut cycle will be getting much shallower. Why? Because if you look at the CME Fed Watch 2, market is now only pricing in next year only 225 basis point cut each. That's it. No longer 3 or 4 basis point cut. No longer 3 or 4 25 basis point cut each for next year. So what you could see over here is that after the December 25 basis point cut, another one likely more or less will be there, because it's quite high at 65% chance based on the CME Fed Watch 2 as of the latest pricing right now. We are seeing a bit of delay, about 1 to 2 hours delay, not really live, but that should be sufficient enough for us to give the current expectation by market participants to bring it down to 4.25% to 4.5%. Then thereafter it will pause in January next year, very high chance of 98%. It will do another cut, potential cut of 25 basis point cut with a 60% chance in the 19th of March meeting, right, to bring it down to 4% to 4.25%. Then thereafter it will pause again in May next year, it will pause again in June next year, and it will start to do another 25 basis point cut in July next year to bring it down to 3.75% to 4%, and that's it. It will pause all the way from September, October, and as well as December next year. All right, so what we could see in the Fed Funds futures pricing based on the latest CME data as we are speaking right now is market is only looking for a higher chance of only 2 interest rate cut next year. Then thereafter it will pause all the way. So that actually reduces the dovishness of the Fed, and that also telling us why the dollar strength starts to emerge in the FX market. So from a intermarket analysis or intermarket dynamics perspective, is the key levels to watch, or the parallel key levels to watch will be 106.65 on the dollar index. So that could actually build the key resistance on the dollar CNH as well, the Chinese offshore yen, 7.365. So if we start to see a clear breakout of these two levels, 106.65 on the US dollar index and the dollar CNH, the offshore yen at 7.3650, that could potentially ignite another risk-off scenario for sure on the Hang Seng Index from a multi-week perspective, and also the Aussie dollar as well. And we also got to keep a close eyes watch on the CBOE VIX index, because now the VIX index is still buzzed into the scenario of the American first policy that is going to be enacted by Trump, benefiting the US stock market against the rest of the world. But do not forget, the global economy is still intercorrelated. So if the dollar strength continues to be persistent, we start to see the dollar CNH inching upwards higher and higher. That could potentially lead to a kind of a currency war coming back into the picture, especially on trade-dependent economies like the South Korea, Japan. Potentially, it could hit Singapore as well, and that could actually see a negative feedback loop back into the US economy. So something to monitor how the VIX will react if 7.365 is taken up on the upside on the dollar CNH and 106.65 is broken to the upside on the dollar index. Right, so this is the fundamental and intermarket dynamics that I'll share with you all for today that has a higher time frame horizon. We're talking about multi-week to a multi-month horizon. All right, so now with that, now let us turn our focus attention to an intraday perspective, so a very short-term perspective, covering the short-term intraday technical outlook across those broad-based cross-asset classes that we do on a daily basis, starting with the FX market first. All right, so with that, let me expand my screen so that you guys could focus on the key trend and the key levels that I'll be showcasing you all in a couple of seconds time. Right, good. All right, so now let us now focus on the FX market. All right, starting with the euro dollar. So still recall on the euro dollar on last Friday, we focus our attention after that bounce that take shape, and we flip. We focus our bearish bias on the euro dollar. So the euro dollar indeed shaped that bearish bias as expected and revisited the low that was actually seen on the we call it on the miss as the US presidential election poll starts to come in over here. All right, so as we could actually look at this perspective at this point in time, so what we could do over here is that at this point in time, we now come close to the 1.0780 level. So I will tighten this 1.0780 level, which was last Friday congestion area here before it plunged during the US session. And if we do the Fibo retracement, also come close to the 61.8 golden ratio as well. So given that the RSI now is at the oversold level, it's now trying already exit from the oversold level as it's going to work out from last Friday oversold we call it condition, still has a bit more room to go before hitting the overbought level again. So there could be some form of a minor bounce taking shape right now heading towards the European session. So this bounce level I will use 1.0780 as my short-term pivotal resistance level for today. As long as this bounce didn't surpass 1.0780, we will still maintain that intraday bearish bias on the euro dollar. Next near-term support level to watch will be 1.0670 followed by 1.0605 level. So 1.0670 is, in fact, you go all the way back, is the swing low area of 17th of June to 26th of June this year. And the 1.0605 is the 17th of April swing low area. And if we were to see the bounce later during the European session, having an hourly close above 1.0780, then today's intraday bearish bias will be invalidated to kickstart another round of mean reversion decline scenario on a intraday perspective, exposing the next near-term resistance level next at 1.0830, which is at 1.0870, which correspond to the 20-day and the 200-day moving average, I think as a similar resistance level as well. Okay, so that's for the euro dollar. Now, flipping our attention will be the sterling pound. So no change on the sterling dollar over here. What you could see is that it reacted off as expected at 1.2990/130.10. So that was the short-term pivotal resistance that we had on last Friday. Price session did a push down over here. So what we could see over here is that now it's trying to work out from the oversold condition that has been made on last Friday. RSI exiting from the oversold condition hasn't hit the overbought level yet, so potentially there could be some form of minor bounce as we head into the London session today. So minor bounce resistance level to look out for. First step will be this level over here, this congestion here. Okay, at 1.2950 level, so slightly below the 20-day moving average, I think as a resistance level. So I do not want to put it so tight at 1.2950 just in case of any whipsaw. So I'll still use the 1.2990/1.3010. We also correspond to the descending channel upper limit that is in place since 30th of September this year. So as long as this minor bounce as we head into a European session, in first step 1.2950, a bit of excess potentially if it could goes above 1.2950, 1.290/1.3010 will be my short-term pivotal resistance level as maintained as on Friday. Then thereafter, we will actually still maintain that intraday bearish bias for it to revisit 1.2845. Below it exposes 1.28 figure level, which is the 200-day moving average, I think as a support level closely as well. Only a push out with an hourly close above 130.10 over here will potentially invalidate today's intraday bearish bias on the sterling dollar to kickstart a mean reversion rebound scenario heading up towards 130.60 followed by 131.10 next, which correspond to the descent to the downward sloping 50-day moving average. All right. So now, turning our attention next will be the Asia Pacific currency against the dollar, starting with the Aussie dollar first. So the Aussie dollar last Friday, we were, because of mixed element, we were neutral. We were neutral between the 66.90 and the 640. So as mentioned, that because of the rather lackluster uh, press conference of the China NPC Standing Committee meeting that refuses to address or ignite more fresh stimulus measure, despite the fact that the Chinese economy is clearly in the risk of a deflationary trend. The Aussie dollar plummeted as well. So what we could see over here is that it plummeted on last Friday, breaking below the 66.40 lower neutrality limit, which is also the 200-day and the 20-day moving average. At that point in time was a near-term support level break. Now hit the oversold region on the hourly RSI. So exit from the oversold region right now. So right now it's trying to work out or this oversold condition that was previously in place on last Friday hasn't hit the overbought level yet. So from now until the European session, potentially there could be a minor bounce taking shape. So minor bounce resistance level to watch 66.20, maximum 66.40, which also if we do the Fibo retracement of last Friday's sell-off, that also correspond closely to the golden ratio as well, and also slightly below the 20-day moving average acting as a resistance. So using 66.40, potential for that minor bounce access level maximum at 66.40, as long as 66.40 didn't surpass the upside, potentially we may see some form of bearish pressure reasserting itself on the Aussie dollar to revisit the minor swing low area on last Wednesday at 65.20/65.10 next. If price action managed to surpass with hourly close above 66.40, then today's intraday bearish bias will be invalidated on the Aussie dollar to see a further potential bounce taking shape to revisit 66.90/67.20, which correspond to the downward sloping 50-day moving average. So that's for the Aussie dollar, flipping to a intraday bearish bias in any bounce, heading towards the 66.40 short-term pivotal resistance level. Therefore, thereafter around this area here, potentially there could be some form of bearish pressure reinserting itself back again on the Aussie dollar. Now, flipping our attention will be the dollar yen. So the dollar yen bounce as expected, a bit of excess over here at 52.45. Okay, bouncing up. So no change there, using the 52.45 here as my short-term pivotal support level. Price action now hitting the first resistance at 53.50, a break above 53.50, potentially revisit the medium-term pivotal resistance level at 154.70/154.80. Only a hourly close and a breakdown below 52.45 will invalidate or negate today's bullish bias on the dollar yen to actually revisit the swing low area of last Wednesday at 155.155/151.30, which correspond to the closely to the 200-day and the 20-day moving average as well. A break below 151.30 will then ignite a much more clear minor corrective decline scenario unfolding in first step to expose the next near-term support level at 150.60/30. So i.e. overall, in a nutshell, in a quick summary is to still maintain that intraday bullish bias as long as 152.45 short-term pivotal support holds on the dollar yen. Okay, so that's for the FX market. Now, turning our attention will be the broad-based stock indices, starting with the Asia Pacific indices, which is the Hong Kong 33. So Hong Kong 33 last Friday, they actually broke below our pivotal support, which is the 20-day moving average at 25.70, and now revisiting the low that was seen on last 2 weeks ago, which is the 31st of October at 20,150 before bouncing up. So what we could see over here is that the RSI now has already started to exit from the oversold level. So potentially there could be some form of rebound taking shape back again back into this region here. If you're able to surpass 20,570, potentially it could go back into this level here. So this is considered as a failure bullish breakout above that 21,050 before that steep sell off took shape over here. So if we do the Fibo retracement of that sell off from last Friday high all the way down to last Friday US session low, US session sell off, and today's Asia session low is also correspond to the golden ratio as well, very closely 61.8% and 76.4%. So with that, potentially this bounce could take shape over here. So as long as this bounce didn't surpass 21,050, we will flip to a intraday bearish bias again. First support level to watch 20,150. A breakdown below it exposes the medium-term pivotal support zone at 19,790/19,445 in first step, which correspond to the rising 50-day moving average. Right, so that's for the Hong Kong 33. Unless we start to see a price action have an hourly close above 21,050, then that would invalidate today's intraday bearish bias to see a recovery, at least for in first step to expose the next near term resistance level at 21,550. So that's for the Hong Kong 33. All right, so now turning our attention will be the next Asia Pacific major stock indices will be the Japan 25 or Nikkei 225. So Nikkei 225 on Friday, we flipped to a intraday bullish bias. Price action came down during the European session, but managed to actually find support at the 20-day moving average before bouncing up. All right. So today we do have a bit of we give it a range, 39,090, 38,940. So that will be my short-term pivotal support level on the Japan 225, i.e. the Nikkei 225. So as long as this support level didn't surpass to the downside, we still maintain that intraday bullish bias within this very complex sideways range scenario that is in place since the low of September 27, right? This very sideways range configuration. So first resistance to watch will be the range resistance level of this complex range configuration at 40,155/40,280. Only hourly close below 38,940, which is the lower limit of this support zone, short-term pivotal support zone, then that would negate today's intraday bullish bias to see the price action floating down towards the lower limit of the range. In first step, 38,670, a breakdown below it exposes 38,265, pardon me, 38,265, which correspond to the 50-day moving average, acting as a similar support level as well. Okay, so that's for the Japan 225. Still maintain that intraday bullish bias using a slight excess below at 38,940 as my short-term pivotal support level. First resistance to watch will be the range resistance level at 40,155/40,280. Okay, so that's for the Japan 225. Now, turning our attention will be the German DAX or the German 30. So I could see this German 30, right? It's a very wild swing on the last Friday. So last Friday we turned neutral. The upper neutrality limit is at 19,510, 19,560. Price action can't break above the neutrality limit and now float back down to below the 20-day moving average, but still managed to hold above the 50-day moving average on last Friday. So I could see over here, right, if I were to connect this lower high, and this similar low, so since the high of 28th of October all the way to the current price action that was being debated on the German 30 or the German DAX, it could be involving in this kind of very descending triangle range configuration where price action continue to print lower high but similar low, same low. So it's like a descending triangle range configuration. Okay, in between there will be a lot of whipsaw that was seen on Thursday and Friday after the US presidential election outcome. So with that over here is that now price action has started to tumble into the middle of the range. All right, so now it's back in the middle of this range again. So with that, right, I will be still flipping to a bearish bias, looking for it to come close to the upper range limit level over here. That means first resistance to watch will be at the 19,390. Above it will be the upper limit of this potential descending triangle range that is still evolving in the German 30 on its hourly time frame. 19,510/19,560 will be the short-term pivotal resistance level to watch for today, aiming for it to actually float up towards the top of the range of this descending range. Flip to a bearish bias, but this bearish bias, the first support level to watch out for will be on this level here. Okay, close to last Friday minus swing low at 19,150, which correspond to the rising 50-day with the 50-day moving average as well, coming to closely to act as a similar support level. Only a breakdown below 19,150 will potentially retest the descending triangle range lower limit or the support at 19,020. However, if price action float up and break above the upper limit of the potential descending range resistance range triangle resistance, then today's intraday bearish bias were invalidated to revisit the all-time high area at 19,690/19,755. Okay, so that's for the German 30. Now moving our attention will be the benchmark US stock indices. So very interesting, right, on the Dow Jones. So on the Dow Jones Industrial Average or the US Wall Street 30, last Friday we have a short-term pivotal resistance at 44,220. Price action rallied and hit the resistance level, and it formed that shooting star candlestick at the close of the US session on an hourly basis, and thereafter it just trades sideways during the Asia session. So what's interesting, after hitting with a shooting star at the 44,220 short-term pivotal resistance that we highlighted on last Friday, the hourly RSI has started to shape that bearish divergence, lower, higher at the overbought level. So with this bearish divergence over here, it seems to us that the post-election move, the extreme move, seems to really hit an inflection level where momentum has started to get winding off, upside momentum, and potentially we may kickstart a minor setback within its short and medium term uptrend phase on the US Wall Street 30 that is still intact because it's still trading above the 20 and the 50-day moving average. Right. So if you look at the daily RSI on the US Wall Street 30, it's still healthier. Okay, it hasn't hit the overbought level yet. All right. So what we are seeing now is only on the hourly time frame. It could be potentially due for a minor pullback or a mean reversion decline to retrace this very steep up move that was seen in the exposed US presidential election outcome. So no change. This is indeed a short-term pivotal resistance that yet to be surpassed. So we still keep this level at 44,220 level. So we have a first support level to watch for today, which is last Friday low at 43,700. A breakdown below 43,700 will increase the probability or odds of this minor mean reversion decline scenario to unfold on the US Wall Street 30, exposing the next near-term support level at 43,370 and 43,060. So if we do the Fibo retracement level, okay, that correspond to the 38% zone and the 50% level very closely. Okay, so however, if price action have an hourly close and a push up with an hourly close above 44,220, then we got to respect this very steep impulsive up move to resume again, exposing the next near-term resistance level, which is defined by a cluster of Fibo extension level, 44,700/44,730 next, all right, in first step, then followed by 44,990. So that's for the US Wall Street 30. Then flipping our attention will be the Nasdaq 100. So Nasdaq 100, we flipped to a neutrality limit on last Friday. So neutral between 20,865 and 21,220. So exactly, it hit the upper neutrality limit and it just paused there. And upon hitting this upper neutrality limit, the RSI starts to form a bearish divergence. Okay, so with this bearish divergence, very similar to the price action of the Dow Jones or the US Wall Street 30 as well. That means this particular steep move over here is potentially due for at least some form of mean reversion decline, at least in the short term or intraday basis within its short and medium term uptrend that is still intact on the Nasdaq 100. So if you look at the Nasdaq 100 daily RSI, it still hasn't hit the overbought region yet, right? And it's still bullish over here on the daily time frame. It's only on the hourly time frame where the RSI starts to form that bearish divergence, right? Indicating some form of momentum. Short-term momentum is bullish. Short-term momentum starts to ease off, and we know that price action don't go always vertical up. There will be some form of what I call mean reversion decline here and there. And interestingly, price action hit the upper limit of the pivotal neutrality range, hit the upper limit of the neutrality range that we had on last Friday. Then thereafter forming this bearish divergence. So with that, I will use this 21,220 as my short-term pivotal resistance on the Nasdaq 100. Flip to a intraday bearish bias for today, but price action got to break down fast of that 21,030. So that was last Friday low. All right, a breakdown of this level increase the odds of this mean reversion pullback or decline scenario to unfold. Next near-term support level to watch will be 20,865, followed by 20,640. So if you do the Fibo retracement of this post-election steep rally, okay, that correspond to the 23.6% and the 38% Fibo retracement as well. Okay, only hourly close and a push up above 21,220 will invalidate today's intraday bullish bias. Then there I got to respect the price action keep on the steep movement will to continue, hitting the next resistance level at 21,390, followed by 21,500, defined by a Fibo extension cluster level. So that's sum up the intraday technical outlook on the Nasdaq 100 and as well as the intraday technical outlook on the broad-based stock indices. Now, turning our attention will be the commodities market, starting with gold XAU/USD. So still recall gold XAU/USD, last Friday we'll be looking for a pullback. So the pullback actually takes shape, still holding above our short-term pivotal support level that we highlighted on last Friday at 2,665. So no change using 2,665 as my short-term pivotal support. So as long as this level holds, potentially there could be the start of a potential minor recovery taking shape on gold XAU/USD. So still maintaining that intraday bullish bias, given the fact that the RSI is now coming very close to the oversold level. 2,665 short-term pivotal support level, maintain that intraday bullish bias. First resistance level zone that you got to surpass will be at 2,728/2,715 before seeing the next near-term resistance coming in at 2,760 on the intraday basis or from a multi-day perspective. However, if price action have an hourly close below 2,665, that would negate today's intraday bullish bias to revisit the 50-day moving average, acting as a support level in the next near-term support zone at 2,643/2,630. Okay, so that's for gold XAU/USD. Now, lastly will be the oil, West Texas crude oil over here. So let me open up the chart of West Texas crude oil. So West Texas crude oil on last Friday returned neutral between 73.15 and 71.50. Price action broke below the neutrality range and as well broke below the 50-day and the 20-day moving average, and also the lower limit of this former minor ascending channel support that I drew from the low of 29 October. So with this breakdown of this 20-day and the 50-day moving average, I will flip back to a intraday bearish bias on the West Texas oil using 71.50 now as my short-term pivotal resistance level that is confluencing with several key different technical elements that is pointing to this level. Former minor ascending channel support now turns into a pullback resistance, and as well as the 20-day and the 50-day moving average also coming close to as a resistance level at 71.50. So 71.50 short-term pivotal resistance flip to an intraday bearish bias for West Texas oil. First near-term support zone to watch will be 69.50/68.85. A breakdown below it, revisit 65.55/60. Revisit 67.55/67.10, which is the lower limit of this major descending triangle range configuration that is still unfolding since the low of 20th of March last year. Okay, only a hourly close back above the 71.50 level will invalidate today's intraday bearish bias on West Texas oil to see a potential push up in first step in the next resistance level to come in at 73.15 that was formerly since unable to break since 24th of October. Only a breakout above this 73.15 with an hourly close above it, then we could potentially see a much more minor meaningful recovery taking shape towards the upper limit of this major descending range triangle configuration, with the next near-term resistance level to watch will be at 75.20. Right, so that sum up the intraday technical outlook on West Texas oil and as well as the broad-based cross asset classes. So before we go, let's take a quick look at the economic calendar on the data to look out for today. So in fact, today will be a very quiet day, not much key economic data to watch out for, except during the European session, there's one key official, ECB official speaking, ECB Macau speaking at 4:10 p.m. Singapore time. And in today's US session will be rather quiet as well. No key data to look out for, no Federal Reserve official speaking. And the next important data to look out for in tomorrow Asia session early morning at 7:30 a.m. Singapore time will be at 8:30 a.m. Singapore time will be the Westpac consumer confidence data for Australia. and the NAB business confidence data for Australia as well that we're releasing at 7:30 at 8:30 a.m. Singapore time that could potentially impact the Aussie dollar movement. All right, so with that, that sum up today's daily dose of market insights. Kelvin here signing off, wishing you guys a great day ahead, and we shall speak again tomorrow. Thank you.